Right.
Right. So we have a lot to do today. We're not completely done with our discussion about black shoals. Also, we have to talk about our assignment. Given that we had such a short time frame, what I've done is I've written a final assignment, and this is it. It's just two problems where you'll be asked to calculate the black shoals price of a call and a put for two different cases. And what I'm going to do here is when we're done discussing the Black-Scholes option pricing model, I'm going to give you what I'm going to call a template, a VBA template to help you get started. Because I know that you haven't used VBA before. And so there's certain things that you have to know about in order to get the ball rolling. And so I'm going to go over that with you today. Now, here's the thing that caught me by surprise. I just looked at the school's website, and to my great shock, I saw that this class officially ends on Friday. So what I would like to do then is not only have this be your final assignment, but if the class ends on Friday, that means they'll accept the grades, let's say the following Monday. So what I can do is have you work on these and hand them in, let's say Sunday night, which would be the 31st, sorry, the 30th of June. And then what's good about this VBA assignment is that, let's say you're working on it and you're getting stuck, it's not working. You can just send the spreadsheet to me and I can open up the VBA and look at it and make suggestions and then send it right back to you so that, we can work on it almost as collaborators. And so that way you don't have to visually or verbally try to explain to me what's going on. I can just open it up and see what's happening. And so this way, I don't think you'll have any trouble getting this done by Sunday night, especially because, like I said, I'll be setting up a template with some things that you might not have known about VBA that you need to know before you write any code for the Black-Scholes model. So first, let's finish up our discussion about the Black-Scholes model. Then we'll get this done. Then we'll wrap up the last two chapters, which there will be no more assignments. So the last two chapters will just be, we'll go over the material, and then you'll get to learn about the Greeks and how they are used to measure risk for options. And then finally, we'll look at the binomial option pricing model, which is the way that we price American options. I'll also make available to you the notes for Monte Carlo simulation. The Monte Carlo is a topic that sometimes we get to, sometimes we don't. It's primarily used for simulations. And what you normally use it for with option pricing theory is exotic options, these very bizarre options with very strange properties often lend themselves very nicely to Monte Carlo simulation. So if we don't quite get to that point, I'll have the notes available online and you can read them if you want to. And it's quite an interesting area of study. There are people who just do simulations all day long and that's all they do. It's a very interesting area of study. What basically happens with simulation is you don't actually use market data, or at least not very much. You're basically taking the statistical properties of an asset and running simulations to assume, um, to find out what happens when market conditions are under certain or reach certain points. So it's a very good thing to do when either you have very little market data or else you don't want to make too many assumptions about the asset that you're pricing. Anyway, so why don't we get back to this real fast? We left off with our discussion about put call parity. And I mentioned that put call parity is a relationship. It shows us how a European put can be priced once we know the value of the corresponding European call. But what I also wanted to do is prove to you why it works. In other words, we know what it is. I showed it to you last time. Um, oh, hold on. Okay, well, here we go. All right, this is the put call parity condition, but I wanted you to see why this holds. In other words, instead of just saying, here's the equation, why don't we go ahead and understand how this works? Why is this true? Now, I did mention last time, the logic behind what we're about to do is this. If we have a situation where we have two portfolios and we're guaranteed that they will both have the same value at some point in the future, then their prices must be equal today in order to avoid an arbitrage. Okay, so in other words, I think I already used an example in these spreadsheets, but oh, here it is. Yes. So imagine we had portfolios A and B. They both have a mixture of treasury securities who are guaranteed to be worth $100,000 on July 1st. We have a bunch of, let's say, a bunch of different treasury bills that will mature on July the 1st. And whatever they are, it doesn't really matter. But the bottom line is they'll both mature on July 1st, and the owner of these treasury bills will be collecting $100,000 guaranteed. There's no default risk. So if that's the case, then the two portfolios today must have the same price. Okay. Otherwise, here's what you could do. If A is cheaper than B, for some bizarre reason, you could buy portfolio A, and then you could take a short position in portfolio B. Now, here we're assuming that you have the ability to do this as a trader for a major investment bank. You certainly could do this. As an individual, maybe not so much, but as a trader for a major investment bank, there'd be no difficulty setting up a short position in portfolio B, where you're basically selling it to somebody else. And that means you're paying them whatever the face value is at maturity. But in the meantime, you're collecting the market value of this portfolio. So because A is cheaper than B, by assumption, by buying A and selling B, you're putting money in your pocket right now, which should not be possible. They should have the same price. And then on July 1st, you own the portfolio A, you'll collect your 100,000. You can then turn around and use that to pay off the owner of portfolio B, because that's how much you owe them. So on July 1st, you have $100,000 coming into your pocket and $100,000 coming out. You have no net exposure on July 1st or any other day for that matter. So the fact that I was able to collect money today and have no exposure in the future means that I've just earned an arbitrage profit. Now, you know that that can't happen in an efficient market, but if it does, and occasionally it does happen in the real world, even at this point in time, most likely what will happen is somebody will notice this and jump in and take care of this. And in the process, what will happen is the arbitrage will disappear very quickly, because in the process of buying portfolio A, price will rise. And in the process of selling portfolio B, the price will fall until, and this will continue until the prices are equal. Okay, because the investors out there are pretty smart. Um, Although at this point in time, it's probably not so much the traders themselves. They have massive computer power behind them, and computers are sitting there looking through market data, massive amounts of market data, and they are looking for these opportunities. And very occasionally, if one arises, they've been programmed to jump in and make these trades and take advantage of these arbitrage opportunities if they do arise. In fact, there are hedge funds called statistical arbitrage funds, and this is all they do. They sift through tons of data in real time, and they're very, very powerful computers, and they have access to all kinds of market data, real time market data. So all of this is very, very expensive. But when they find these opportunities, they have the ability to grab them, even if they only last for fractions of a second. Okay, the computers are fast enough to jump in and take advantage of this. And so what that means then is that these opportunities, if they ever do arise in the first place, will disappear just like that. So the fact that computers are looking out for these opportunities means that markets will be extremely efficient. Maybe not perfectly efficient, but extremely efficient. So anyway, what does that have to do with put call parity? Well, basically, if you look at the way it's written, um, the condition is, let me just copy that into this document. Here we go. Just as a reminder, that's what put call parity looks like. We can rearrange it algebraically. In the following way. So I subtracted S from both sides. Now, what exactly is happening here? The left-hand side can be thought of as a portfolio consisting of um, a long position in the put, a short position in the stock. And by the way, in this case, I just want to remind you that here, the original put call parity condition that you're seeing here is based on the Black-Scholes assumptions, including the fact that both the call and put are European, written on the same asset S, and maturing at the same time T. And so what you've actually got here on the left-hand side, it's as if you set up a portfolio where you bought the put and took a short position in the stock. Oh, that was the other thing I almost forgot. The underlying asset is a non-dividend paying stock. That was the original Black-Scholes. So we don't have to worry about cash flows. Now, the right-hand side of this equation is a little bit more complicated. Can be thought of as a portfolio consisting of a long position in the call. Now, what is this XE to the minus RT? So here's what we have to think about. Think of this as a long position in a treasury bill with face value X. Now, here's why this is what we can think of it as. This right here, what this represents is the price of this treasury bill. Now, if you recall the way treasury bills are set up, treasury bills are sold at a discount from face value and then redeemed at the full face value. So in this case, the investor pays this much for the treasury bill today, and receives a guaranteed X at the maturity date. Okay, that's an important detail. So in other words, you're paying a discounted price now, and by the way, the maturity date, I want to mention this too. This maturity date matches the maturity dates of the call and put. That's a very important detail. They're all expiring or maturing at the same time, in other words. Okay, that's otherwise none of this works. Okay. Now, here's the thing. We did mention that in order to avoid an arbitrage. Now, first of all, what we want to do is demonstrate that on the maturity date of these options, the cash flows to both portfolios will be identical to each other. That's where we're going to start. Okay. So why would you think? Now, here I set up a little chart. The portfolio P plus S. Oh, I'm sorry. Look at this. I made a dumb algebraic mistake. P plus S. All right, equals C plus XE to the minus RT. So P plus S is the first portfolio, and C plus XE to the minus RT is the second portfolio. So in the future, on the maturity date of these options, there's really only two things that can happen. The option, well, actually, the stock price at time T, I'm writing it as ST to distinguish it from S, which is today's price. It's either greater than or equal to X, or it's less than X. Those are the only two things that can be true. It doesn't matter for our purposes here how high the stock price is going up or how low it's gone. All that matters is this part right here. We can break this up into two scenarios. And so in the first scenario, the put here is out of the money, but the stock is worth what we're going to call ST dollars, the stock price at time T, which means the portfolio is worth ST. Down here, the call is going to finish in the money. It will be exercised and provide a payoff of ST minus X. We also collect the X dollars, as we said, from the treasury bill. And when you add these up, you can see that the portfolio is worth a total of ST dollars. So in other words, both portfolios are worth the same. In this scenario, the put is in the money. The payoff is X minus ST. We also own the stock. So altogether, our portfolio is worth X dollars. Down here, in this scenario, the call finishes out of the money. So all we're left with is the X dollars from our treasury bill. So these two equal each other in the first scenario, and these two equal each other in the second scenario. It doesn't matter that this one is different than this one. What matters is that the two portfolios have the same cash flows on that maturity date. So therefore, that implies that according to what we were just talking about, the prices have to be the same today. In other words, P plus S must equal C plus XE to the minus RT. Otherwise, there'll be an arbitrage. And so then we just rearrange this algebraically, and we end it right back up with our original put call parity condition. So there we are. We've just proven this notion of arbitrage that this condition has to hold. Otherwise, there'll be arbitrage opportunities. And as people exploit those, the prices will adjust until this condition holds again. And most likely, if this is violated, it'll be exploited so quickly and by so many computers out there that the opportunity will disappear in fractions of a second. Okay, so we call this an arbitrage-free relationship. Or sometimes, sometimes it's called a no arbitrage relationship. Now, not every relationship in finance is arbitrage-free. There are many relationships that tend to hold in the long run, but it's not possible to exploit them if they fail to hold. Okay, but in the derivatives markets, virtually all the relationships that you'll be looking at are enforced by this notion of no arbitrage. Because it's usually possible to take whatever asset we're dealing with and reproduce its cash flows with a portfolio of other assets. Okay, that's the key to all of this, our ability to take one asset's cash flows and reproduce them with other assets. Okay, and that helps us derive the price for the first asset. In fact, the Black-Scholes model itself is based on the same logic. All right, now let's go back into our spreadsheet and do the put call parity. Oh, it looks like we've already done it. Okay, now what we come across next is this idea that Merton, being one of the three developers of the Black-Scholes model, after this paper came out, he sat down and wrote some more papers, so did Fisher Black, by the way, in which they showed us how to price options that do not depend on the assumption that the underlying asset is a non-dividend paying stock. Because, and the reality is most options fall into that category. Most options are written on assets that do provide some kind of cash flows. So what they did was they're able to adjust the model by assuming that the cash flows themselves are paid out on a continuously compounded basis, which for some assets, that's not a terrible assumption. For others, it's a little shaky. Just as a perfect example of this, what if we're trying to price a currency option? Let's say I'm trying to buy an option on the British pound. The thing about the British pound is if I own British pounds, I can deposit them in a British bank account and earn the British rate of interest. I can go into the euro currency markets and earn that euro currency rate of interest. And interest rates, as you know, are typically compounded on a daily basis, but we've already seen that the difference between daily and continuous compounding is very slight. So we can then assume that if I own British pounds, I'm earning a continuously compounded interest rate. And so an option written on that pound would have to take that into account. And so the way we do that is by creating this new variable Q, which represents the continuously compounded rate of return to the asset. And then everywhere we see an S, saw an S before, it is replaced with SE to the minus QT. So you'll see it here. And also it affects D1. Now, it may not look like it, but algebraically, having SE to the minus QT up here can be rewritten as you're seeing here. All right, so all we've done here is change two things here and here, right there. Now, as it turns out, this is going to affect the Pocoll parity condition. So let me jump ahead a little and show you how that would be affected. Um, it's pretty much just what I just said. S is being replaced with SE to the minus QT. And the reason why it's happening here is because the existence of those cash flows reduces the value of an option to buy it. Okay, so there's a call value is reduced because the owner of the call is not getting those cash flows. So why don't we look at an example in Excel, that is. Here we go. So here's a different one. This is one that has a stock. Here we go. A stock sells for $30, and let's assume that the dividend yield is continuously compounded. Now, that is quite a stretch for a single stock, but for a stock index like the S&P 500, it is not as much of a stretch at all. In the case that the dividends are being paid out at different times, and for 500 stocks, a collection of 500 stocks paying dividends, it's not that much of a fudge to treat it as a continuously compounded rate of return. Even here, you know that you can convert one compounding convention into another. I mean, even though dividends are typically paid quarterly, there's nothing to stop us from taking a quarterly dividend yield and turning it into the equivalent continuously compounded yield for this model. So we're not really doing anything outrageous here by assuming a continuously compounded rate of return. All right. Anyway, I mean, it's a bit of a stretch, a little, but it works. Okay, so the risk-free rate of interest is 5%. That's the yield on a treasury bill that matures at the same time as the option. And so that's over here. So we have a stock price of 30, strikes 28. So you can see for a call option, this is $2 in the money. The risk-free rate is 5%. The volatility is 20% per year by assumption. And they would have obtained that number by looking at the recent history of the returns to that stock and calculating the continuously compounded rate of return, and then doing the standard deviation of that. And then we also are told it's a 6-month option. Okay. So remember, time is in years. So therefore, we call this 0.5 for 6 months. And the dividend yield is 3% right here, continuously compounded. Great. So then D1 is slightly different than what we did before. We have log S over X plus R minus Q plus a half of sigma squared times T. Now, all of that is my numerator. I'm going to surround these with parentheses. And then I can divide by the product of sigma times the square root of T. D2 is easy. It's just D1 minus sigma times square root of T. And now remember, the Excel function for that is norm.s.dist. So you can put the D1 here, and cumulative is always 1, by the way, for at least for what we're doing. And then for this one, norm.s.dist of D2, D2, comma 1. And now Now these guys, you'll see why we might want to use them. It's not absolutely necessary, but I'll do that right now. Norm.s.dist of negative D1. Oh, I keep forgot. I'm still not used to that one there. And then norm.s.dist of D2, negative D2, that is. Common one. Don't forget that one. That's a relatively, you can tell. I used the other one for all those years and now they just changed it on me. So the models are right here, S times, now remember exp to the minus Q times T. And by the way, the VBA code will be very similar. There's a couple of important differences that I'm going to show you. Times ND1 minus, and again, now we have X times EXP minus RT, or times T, that is, times ND2. Okay, it's approximately $2.89. Now, if you notice, the time value is only about 89 cents. Okay. For one of the reasons for that is because it's only a 6-month option. And number two, the volatility is lower than in the previous example. The volatility has a major impact on that time value of money. A higher volatility raises the time value because it increases the likelihood of your option finishing in the money. In fact, if you wanted to fool around with it, you could try, like, well, don't forget the original values, but if I change this to 0.4, watch what happens to the call price. Yeah, so the time value suddenly is like 237. So the great thing about setting this up in Excel is that, or even we're actually even using VBA to create a function, is that you can tinker around with these assumptions and see what happens and gain some real insights into how options are really priced. The thing about sigma, as we'll see in the Greeks discussion, is that this one always adds value to your option. With options, you want volatility to be high because that really pushes the price of the option. Now, for the put, we can use this put call parity condition with the call price plus X times, again, EXP minus R times T minus S times EXP minus Q times T about, oh, I think I must have done something wrong. That doesn't look right. Oh, that explains that. My D's are, how did that happen? Well, let's find out. No, clearly something's not right. I did wrong. Oh, you know what? I didn't put parentheses around the denominator. There you go. I screwed it up royally. See what happened here was that, oops. In the denominator, algebraically, I put parentheses around that product because otherwise it assumed that I meant all of this divided by B4 and then multiply by the square root of B5. So the reason why it's off is because I didn't have parentheses in the denominator. The thing about parentheses is there's no penalty for you having too many parentheses. You know what I mean? It's like one of those things you should use it. If there's any doubt in your mind, if you need them, you should use them because you can't mess up anything by using too many parentheses unless they're placed incorrectly. All right, now we're talking. So the call is about $3. The put is about 72 cents. And that's, of course, because it's out of the money by $2. The price, by the way, these prices can't ever be negative. Otherwise, there'd be an arbitrage, as you can imagine. They also can't fall below the intrinsic value. So like this call If I looked in the Wall Street Journal and this call was selling for less than $2, that means there's an arbitrage. It can't sell for less than the intrinsic value. It usually sells for more, in some cases, quite a bit more. Anyway, it turns out that there's a second alternative way of getting to this pull call parity condition. We didn't really go over that last time. It basically involves plugging this C into the Black-Scholes model. So if you were to do that, oh, it's not in here. But just all right, just be aware that these n negatives are needed if you're going to use that alternative approach. In fact, I think it's in my discussion here. Here it is. It's kind of a mess. You might as well just stick with the pull call parity, but this other approach does exist, and it does require these negative n negative D1 and negative D2. You can use these if you want, but I think this is easier. All right, anyway, so now that is the end of chapter 6A. We're ready for the Greeks, which is 6B. So we're going to run through these fairly quickly because I want to make sure we have time for the binomial option pricing model. And you won't have to write any assignments about that because it is a fairly complicated model, but it's important to understand how it's different than the Black-Scholes model and why it enables us to price American options. Okay, so here's 6A. We're done with this. Oh, I know what we almost forgot to do. I have to show you my template. Okay, we don't want to forget that. Okay, so I've set this up. Now let's look at your assignment. So this first one, we have European coal and Nike stock with a strike of 100. So I put these here for you. You should always put your assumptions right on that spreadsheet. The option matures in 6 months. Volatility is 30% per year. Oh, whoops, I put it in the wrong spot. Risk-free is 2%. The price of the stock. Now, by the way, if you notice, this one doesn't mention anything about a dividend. So let's let the Q go to 0. Okay, the second problem does have a cash flow. This one does not. So we're going to leave the Q at 0. Now, what we need to do here, by the way, you can feel free to double check your answers by using Excel. All right. In other words, you can plug these into your other spreadsheet. This one, either that or just steal the formulas. I mean, the only problem is it's laid out a little differently, but if I came back here and plugged in these same numbers, you would see the correct numbers. But we want to get them with VBA. So this way you can double check them. Actually, I'll tell you what, there's no reason why we can't do it this way. This will be your double check. Let's put it that way. So if you just copy these numbers over here, oh, wait, what happened? Oh no, it's right. I must have just left it out. Wait a minute, hold on. I'm just going to copy this one more time. I don't know what went wrong over here. All right, let me try that one more time. All right, so the reason why I'm doing this is because I want to copy these over here. And so you know already in advance what you're supposed to get. What we want to know is if you can do this with VBA. So here's the template we're going to set up. And what you're going to do is create a function that you'll execute right here in this cell. It'll be something like this, BS call or something like that. And then it'll put the number you need right there. So you'll go into VBA. Double click sheet 1. Actually, no, no, don't do it like this. We need to insert what's called a module. Okay, otherwise it'll get confused with the naming conventions. And you can rename the module right here. Let's call it BS call. Okay. Now we're going to call it a function. So just to be on the safe side, why don't we all, okay, BS call. So it's going to be function. And you're going to need to tell it what values it needs to read in. And we're going to use these names because they make sense. I hope you'll agree with me. Um, we needed to know. And by the way, let me just double check something. Guess we can close this one out. Oh, by the way, there's one thing I wanted to mention here. In some half the derivatives textbooks in the market, they use the letter X. Hull used to use X all the time, and then he switched it. X for the strike price. Some books use K for the strike price. Okay. It doesn't make any difference what you call it as long as you're consistent. I just realized the code has a K in it. So I'll tell you what, just to avoid any confusion, let's put K's here with the understanding that K is the strike price. S is the asset price. R is the risk-free rate. Sigma is the volatility. T is the time to maturity. Q is the dividend yield. All right, just so there's no doubt in your mind what you're doing here. This is the call price, and P is the put price. Okay, now we're good. So this is your job right here. So, but I'm helping you start it. Now you would typically, you might want to make some calculations. If you have any constants, if you recall, actually, you know what I'm going to do? Let me go grab the formulas. So, by the way, just to make it as general as possible, we're going to actually use the so-called Merton model, which means the extended Black-Scholes. So that way, if you have a Q, you don't have a Q, you can set it equal to 0. It's easier than trying to readjust it to include a Q after the fact. All right. So you see what I mean? You should probably always use this version of the model. And if worst comes to worst, if there's no asset cash flows, just let Q equals 0. So we're actually not using Black-Scholes here. We're using what Hull calls the Merton model. Um, because this was his idea. Merton was really the math guy in that team. Black and Scholes were economists, I believe, or either that they're finance guys, but Merton was the only one who was a true mathematician. So that's why he was able to go ahead and take this model. In fact, he made a lot of incredibly important suggestions when he came. I don't know how he even met those guys. They were all at different universities. But I met somebody once who actually had a class with Robert Merton at Harvard. He said he's the most humble guy he could ever imagine, considering that he was a Nobel Prize winner. And he basically revolutionized the field of finance. One would think he'd be an egomaniac. Apparently, Myron Scholes was an egomaniac. I don't know what it's called, but not Merton. He was as calm as they get. I don't know what the hell is going on. It's supposed to obey me, and of course it won't. Unbelievable. All right, I'll move it down here. Oh, we also have minus S. By the way, I'm going to show you a helpful trick here. You notice how it goofed up the superscripts. I'm going to show you how to fix them. If you've never seen this done in Excel before, you'll be very pleased that you've learned this information. Let me make sure I didn't goof it up. So what you have to do is the E, the minus RT is in the wrong spot. So if you highlight it, right click, format cells, say, hey, I want a superscript, please. And I'll do the same thing for the last one. Yeah, see, these are the little things you have to learn. You can also put in Greek letters here if you know what you're doing. You have to insert symbol, and it'll find them for you. All right, anyway. Finally, all right, so now we're all set. So here's what we're gonna do. Oh God, I almost forgot about this. Um, if you're gonna write VBA code, you can't save it with the traditional SLX. Oh, this is so important. You have to call it macro enabled workbook. I almost forgot all about this because otherwise it'll treat your macros as viruses and it'll zap them. So in order for you to actually save this work, you must save it with the format is, I think it's called XLSB, but it's an Excel macro enabled workbook. See how when I tried to save it there, it was basically giving me a hard time because I hadn't done that. In fact, if you look at the ones I sent, I guess we haven't looked at too many of these. Oh, I was showing them to you in a different format. That's why. Okay. Oh no, it's XLSM. Okay, that's what you need, not XLSX, which is what we're used to seeing. It has to be XLSM. If you didn't know about that, you would have been in loads of trouble. Anyway, what I was starting to say is that these two are constants that we'll need throughout the program. So why don't we define them now? Disk R will be, now, by the way, this is something common between VBA and Excel. EXP is spelled the same way. So that is e to the minus RT. And then e to the minus QT, we're going to call it disk Q. And now you can refer to them with those names rather than having to type that formula out every time. Now, the other thing we have to do is this. Now, this is where it really gets interesting. By the way, I almost forgot. Not that it's necessary. But what the heck? We might as well take advantage of that. Now, in the body of this Black-Scholes program, you'll need to calculate ND1 and ND2. So what we're going to do is something more interesting. Not that this is necessary. I'll tell you what, let's do it like this. So now here we need the formula for D1. And by the way, I guess here's what I'm going to do here. Oh, it's upset because I'm in the middle of a sentence here. We need to tell it the formula for D1 and D2. Okay. So I'm going to put an apostrophe here. That means that this is a comment. So you're going to fill in the formulas for D1 and D2. Okay, that will be your part. And the only thing is I want you to know is that the only tricky part there is that, and I'm going to add this in here, note in VBA, natural log is spelled log, and square root is spelled SQR. Okay, these are two that are different. These are VBA functions. You must use these, not Excel's versions. So if you type ln and it'll blow up and you'll say, what's going on here? We don't want that. Okay. Now, what you're going to do next, oh, baby, this is tricky. You now have to, the ND1 and ND2 is pretty complicated. So I'm going to help you with that because you're using the norm.s.dis, but in order to invoke that in VBA, you not only have to know how to spell it, but you have to find what you're going to be finding out is that that is an Excel function that only exists in Excel. In order to bring it into VBA, you need this command application dot. Now, in order to be consistent, now when you call for this, you have to not only, well, actually, no, this is not really, I just realized this is not necessary because you're already figuring this out. Just do this. This should do it. Though I'd written it originally in a slightly different way, and I just realized this is a little simpler. Let's do this. By the way, you don't have to worry so much about the spelling. It'll correct, I mean the case. You don't have to worry about the case that much. It will help you with that. It'll fix it if you do something wrong with the case. Okay. And then um you need now this is really important. The last line of the code will be. I'm going to leave it as a comment. I don't want it to blow up. You have to tell it what to do with this BS call value. And then what you're going to put here is the Black-Scholes formula. So what you're basically going to do is basically just take away. I'm afraid that if I uncomment it, it'll blow up because those values haven't been calculated yet. Okay, and then what you have to do in order to I'm going to give you a helpful hint right here too. I'm going to put this here. The program you just created requires you to enter SKRQT vol. So in other words, when you That's what you're going to type here. Okay, so in other words, you're going to type equals BS call. But what I recommend you do is not type those letters, type the cell references. In other words, here that would be B1, B3, B6, B5. Oh, wait, I did something wrong. Oh, it's B1, B2, B3. Oh, there's only one that's out of order, B6, B5, and B4. Okay. Now, if I type it now, it'll blow up because it doesn't know anything about this BS call function. Yeah. But once you've written it, once that code is finished, it'll work perfectly. And the same thing here, we're going to call this one BS put. It'll invoke it the same way. Okay. So now here, okay, here's what we're going to do. We're going to go back to VBA. Oh, you know what I think we better do? I just realized I'm going to add one more detail here. What we're going to do is we're going to use that more complex version. It'll be easier here because if not, you need to invoke the call. You need to have it run the call price and then read it into the pull call parity condition. So I think for this one, we might want to use this more complicated version right here. So it's going to be S. Okay, wait. Let me go back to the slides for a second. I'm not sure if I put it in the slides. Actually, you know what? I don't think any of this is necessary. I'll tell you why. Because I think you can call one function with another function. Let's do it that way. In other words, within the same spreadsheet, by defining BS call, it thinks that's an Excel function now. So you can use that. All right, I'll tell you what, let's try it that way. I like that idea. For the put, you're going to put in the code. All right, let's go back here. Oh, by the way, we need to insert a new module now. We're going to call this BS put. And then it'll say BS put. And then you'll have the variables in the same exact order, just to be consistent. SKRQT all. All right. Now, steal what we need from here. So I'll tell you, I think our best bet is to now, even though this is not as efficient as it could be, um, we're going to run the Black-Scholes call again. Actually, no, it'll get confused if I do that. Let's do this. I'm gonna just put these here just to be on the safe side. Oh, oh, I just realized, no, and you know what's upsetting it? The word call. We're not allowed to call it that because that's reserved for something else. Let's call it BSC for Black Scholes call. How about that? I don't want to call it BS call because then it thinks I'm calling the other function. Let's call it BSC then. And I'll put a little note here. Okay, that's better. And then we can just use straight ahead hook call parity. And also while we're at it, I think I want to add a little more here. Just to be on the safe side. So anyway, the reason why I'm doing this is so you run this program. Uh, but don't forget, you have to fill in D1 and D2. That's like your job basically. And then we'll call it BS put. And this will just be the protocol parity condition, which means BSC. Actually, sorry, no. Yes, BSC plus X times, well, we're call e to the minus RT, we're calling it disk R. And then we're going to subtract stock price times disk Q. Okay. So in other words, we feed the BS call into the BS put function. We're going to solve it. Solve for the put price with book call parity. The other formula was a lot messier. Let's just stick with this approach. Oh, by the way, I've accidentally created two end function statements. That would have blown it up big time. Okay. So the code is there. So yeah, again, this is what you're going to do. You'll type equals BS call with these numbers, but use the cell references. And so that should take care of that. Now, there's two of them. I'll put all of this onto the second sheet. And the only thing I have to change is these details. If you look at your assignment, here it is. This time, it's a call on the British pound. The strike is $1.50 per pound. So I'll put that in here. Actually, you know what? There's a clever way I could have avoided needing to retype these. This is a better way to go because this way, if you have to change something in column B, it'll automatically update itself in column E. Okay. So I'm going to do that right now. Okay, what else is different? Here we go. 9 months, which is 3/4 of a year. Volatility is 40%. Risk-free rate is 2%. That's still two. And UK rate is 4. That's the Q, by the way. That's the tricky part. The Q is the 4.04. That's the British rate of interest. The exchange rate, the current exchange rate is $1.60. That's your S. Oh, I know what I did wrong. Strike is $1.50. There you go. I did that incorrectly. This it's a 9-month option. The volatility is 40%. The risk-free rate is 2. That's the US rate, by the way. UK rate is 4%. That is what you would earn as the owner of the British pound. So that's why that's Q. And the exchange rate, the spot price of the exchange rate for the British pound is $1.60. Okay, so this is what you're supposed to get. You can use the exact same code for any options you want now. I mean, it's all set up. So all you have to do is make sure you use these two functions. And so you need to add a few details, but this is your template. And you can now use this to price any European call or put, whether it has a dividend yield or not. Okay. And if not, you like Q equals 0. So you're in pretty good shape here. Now, if we had a normal semester, we could write a bunch of new programs, but we don't have any more time. So we're going to do it we're going to focus on Black-Scholes because really this is the most important topic of the course, I think. And so, well, you get some practice with the VBA and, well, that will have to do it. In the meantime, we're just going to carry on and learn some more new content, by which I mean specifically the Greeks and then the Black-Scholes, the binomial option pricing model. Okay, so I'll make sure I post this on Blackboard. Now, if something goes wrong, if I've left something out by mistake or we forgot something or anything, you can just send me an email or I'll send me a copy of the spreadsheet and I'll take a look at it and see what happened. All right. Like that business about saving it as an XLM file. I mean, really. Okay, so we don't need this anymore. So we can just dive right into 6B where we introduce the Greeks. The Greeks won't take that long. The Greeks are a group of risk measures that help us understand the properties of options. They can be used very easily for hedging purposes or for trading strategies. They're known as the Greeks because many of them are named after the Greek letters, although not all of them. Now, by the way, I just want to show you something interesting. If you really find this topic interesting, we're looking at the basic Greeks, the standard ones, the ones that are used by everyone, and they have been forever. But there's more. If you really want to look at them all, there's an nice article on Wikipedia. Don't ask for Greeks, by the way. It thinks you mean Homer and Plato. Somewhere in Wikipedia, or either that or Investopedia, they have a nice chart which shows you all of them. Oh boy, this isn't it. Well, anyway, it's out there. Yeah, you'd be surprised if you can't find any financial topics on Wikipedia. They often have it on something called Investopedia, which is really specifically meant for, as you can imagine, finance topics. And it's really very good. It's very reliable. Anyway, so here are the basic ones. And you can see they're all, except for this one, Greek letters. Now, I don't know who gave them their names, but Vega is not a Greek letter. It's actually a star in the constellation Lyra. So that makes it awkward to write it as a symbol. So sometimes we see the Greek letter lambda used in its place, but Vega is not a Greek letter. It sounds like it should be one, but it isn't. Okay. So the delta is really the most important of them all. Think of it as the sensitivity of the options price to a change in the price of the underlying asset. So in other words, if I tell you what, let's go back here and reopen our Black-Scholes spreadsheet so you can see what this is all about. from chapter 5. Um, what I want you to see here is that, yeah, I guess this is not the one we were doing before, but it'll do the job. Anyway, what I wanted you to see here is this. The call price when the stock is 52, the call price is approximately 7.633. What if I raise this by $1? Well, actually, I'll tell you, let me organize this a little differently. The call price. It's approximately 828. So it went up by approximately 65 cents, let's say. So that number is the delta of the option, approximately. The delta tells us how much the option price will change when there's a change in the stock price or the asset price. Okay, so here it went up. Now, by the way, if I go down to 51, the difference is now from 52. It's not exactly the same. So in other words, keep in mind these Greeks are only approximately correct. And so the actual delta of this option, now here's an interesting twist. So the delta is the sensitivity of the option price to a change in the asset price. It's just that simple. Now, it turns out, interestingly enough, if you look at your Black-Scholes formula, delta is equal to ND1 in the Black-Scholes formula. What an interesting twist. So in other words, right here, when we're at 52, the delta, according to this, is about 0.6359. So you can see these change by about off a little bit, but that's pretty close to 63.59. So that's the predicted change in the price of the option rather due to a given change in the asset price. Huh. Actually, I'll tell you what, I'm going to save this document with a new name so I can save it. So we don't lose this information. This is part of chapter 6, so I'm going to rename it Greeks examples or something like that. Okay, so this is an option that we priced, both the call and the put. And here we're seeing what the delta is all about. So more formally, this is how it's written. Now, if you notice, this is the notation here. You've seen these before. These are partial derivatives. And the reason why we need a partial derivative is because C is a function of many variables. So therefore, we're only interested in changing S rather, and seeing its impact. In other words, it's assumed that the others are staying fixed when we change the stock price. So that's why it's actually a partial derivative. And over here, of course, this is the Greek letter delta with a little c that tells me this is the call delta. Now, the call delta has some interesting properties. By the way, where's it coming from? You remember this graph? This is the payoff profile. This is the market price up here. And so the delta is nothing but the slope of the market price at a given point. Okay. So when we had 52, let's say the option we were just looking at, X was 50, we were at 52. Slope right here would be the delta, which was approximately 0.63 something. Let's call it 6359. Usually we quote this with 4 places of accuracy. Now, that tells me, now if I own this option and I'm afraid that the price is going to drop, or if I'm hoping it'll go up, this will give me a sense of how much of a gain or loss I will increase or earn if that happens. Now, by the way, this graph is also a good way of seeing how and why the delta is not perfectly accurate. Because if you look at this thing carefully, this is not a linear function at all. And yet we're using a tangent line, which is a straight line, to approximate the changes in that curve. So you can see why there can be inaccuracies. And as S gets further and further away from its original position, the inaccuracy will increase. Okay. So the put has its own delta, of course, except now the delta will be negative. Okay. If the stock price goes up, the put will go down. So you can see from this graph, now you can see that, of course, it is the slope. The delta is the slope of this curve, and it's always going to be negative. But it can't go outside the range, 0 to -1. Okay. Here, the call delta has to stay in the range. Okay. So if we look at our example here, we've got, oh, by the way, because of the way they're defined, let me add this here. And that means this number. The put delta is ND1 minus 1, which means that the corresponding put delta is this. Okay, I'm going to round this to 4 places. And there we are. So that means that the price of the stock goes up by $1. Let's see what happens. Let's make this a little chart, except with the put prices. And let's see how accurate it is. All right, so initially we were at about 464. And now we're going to let the price go up to 53. And the new put price is about 429. And then I'll let the price drop by 51. And we end up with about 501.9 something. So the differences are so the delta, as we just saw, is about 3887. Oh wait, actually no, sorry, that's no longer that we needed to be at the same stock price. There we go. When the stock is at 52, the delta of the put is -3641. You can see that's pretty close. If we, by the way, if we only allowed the stock price to go up by a penny, for example, then these would be extremely accurate. Okay. $1 is not a huge change, but we're getting further and further away from the original price. If I let these go up by $10, you'd see that the accuracy would really decay very quickly. Now I do want to point out here too that when this is all based on the Black-Scholes. If we're using the so-called Merton model, then we can adjust it to allow for that Q term. Oh, by the way, here's some interesting graphs. If you notice how every time I change the stock price, let's put this right now, the delta is at right here, 34 something. If it changes to 53, the delta goes up. If I knock this down to 51, the delta goes down. Sorry, this is the delta. What am I doing? This is the call delta. All right, let's try that experiment again. I think I was looking at the wrong spot. So we started at 63 something, then it goes up to 65 something, and then when it goes down, it's down to about 61. So in other words, the delta changes with the stock price. You can see why, because if you look at this graph of the market price, well, sure, the slope is changing. In fact, as we move deeper into the money, the delta approaches 1 as we get deeper and deeper into the money. On the downside, the delta approaches 0. Okay. And that's, you can see why, because the curve is, of course, changing. Same thing with a put, except that it's getting closer as it gets deeper in the money, the put delta gets closer to -1. And as it gets further out of the money, the put delta gets closer to 0. So if you plot, let's say you went through and changed the price many, many times, you get a curve that looks like this. There it is. The call delta, I went ahead and recalculated the delta for many different stock prices, and it has this nice S-shaped value. You see at the bottom, it's bounded from below by 0 and from above by 1. The put delta is bounded from below by -1 and from above by 0. Now, if you notice the shapes are identical, that's not a coincidence because they're only different by a constant. Now, that's an important detail. We'll see why in a bit. These deltas are actually, these Greeks are actually quite interesting. Also here, this is showing you, it turns out that as time elapses, now remember, let's go back and review this for a second. As time elapses, what happens to this market pricing curve? So when we have a long time to the maturity date, let's say this is 6 months to maturity. Then we'll put green for 3 months. And then let's say purple will be 1 month. See, the curves are getting closer and closer to the payoff. So the deltas are changing too. The option that is deeply in the money, the delta is getting closer to 1. That's the red one on top. Oh, by the way, one more thing. This is just to avoid confusing you. The way this horizontal axis is written, this shows me that there's a year to maturity. Here, I'm right on the cusp of the maturity date. So you have to read this graph from right to left. So here, this one is in the money, and it's getting close to 1. Out of the money, it's getting close to 0. And at the money, it's converging to a half as time elapses. So time is elapsing from right to left. It's a little confusing, but if you look at the graph, you'll see on the horizontal axis, the time to maturity starts at the right at 1 year and works its way over to 0 here. And then the put delta, you can see it's the other way around. The out of the money is going to zero, in the money is going to -1, at the money is going to -0.5. Okay. Now, if there is a yield, there's a Q involved, the formulas are going to be slightly different. Okay, I just want to show you, all you're really doing is multiplying the original values by e to the minus qt, which unless Q is a huge number, that's going to be a very, very close to 1, like 0.99 something. So this is a very small adjustment that needs to be made if your asset does provide some kind of cash flow. Just want to mention that. Now, gamma is the companion of delta because the gamma basically is telling us how sensitive the delta is to changes in the asset price. Because we know that the delta changes. We just saw it. We saw that graph. So the gamma is trying to essentially capture how quickly this is happening. In other words, it's the slope of this curve that we're looking at now. And so what does that look like? The formulas are here, but let's take a look. This is what it looks like. So you can see the gamma peaks out when we're at the money, and then it falls off in the other two directions. Now, because these two S-shaped curves are the same for the call and the put, the gamma is actually identical for both calls and puts because the slopes are the same. So the thing about the gamma is that, number one, it's always positive because you saw those curves have positive slopes throughout. Number two, its value depends on the so-called moneyness of the option. It's always at its peak when the option's at the money, and it falls off as we move away from the money. And the most interesting thing is that it's identical for calls and puts that are themselves based on the same asset, the same strike price, and they have the same time to maturity. We don't need a separate formula for put and call gamma. Okay. Why do we have gamma? Well, if you're setting up a hedging strategy of some kind, you have to be aware that your strategy may need to be adjusted if market prices change because the deltas are going to be affected. So the gamma lets us figure out how much is going to happen and how much we may have to change our strategies. And you can see, just like before, the gammas change over time. The at the monies spike up as we get towards maturity. The other two converge to zero. And that's true for both calls and puts. All right. So, and again, if you have a continuously compounded yield, we can adjust it like this. Now, we also have the other three I want to mention, although I must say these are the most important two as far as hedging strategies go. In part C, we're going to look at the last three Greeks. Theta is an interesting one. Theta tells us how much the value of the option declines as time to maturity approaches zero. Because remember, a large part of the option's value is its time value. And so this refers to how quickly that time value shrinks over time. In fact, let's go back and look at that graph I had here. Oh, here it is. So you can see that as time elapses, the curves are getting closer to the payoff. So actually, let me just mention this here. Gamma refers to the sensitivity of delta as asset price changes. It is always positive and is identical for all inputs that have the same asset, time to maturity, and expiration, same asset, same time to maturity, and same strike price. Theta refers to speed with which the time value of an option decays, as we call it, as time to maturity approach, as the maturity date approaches. Okay, in other words, the closer these curves get to the black line, the less time value we have. And on the final day of trading, there's no time value at all. So in other words, how quickly is this happening? Now, because of the way it's defined, the theta number is actually negative for the most part because it shows you how quickly you're losing value as you keep holding this option without exercising it. The formula for this is really pretty nightmarish. It's different, by the way, for calls and puts. They're both affected differently by the passage of time. So, um, we don't need to dwell on this too much, but I also want to go through the last two very quickly. Vega, the badly named Vega, because it's not a Greek letter, refers to the sensitivity of the options price to changes in volatility. Okay, so let me put this in here. Now, what's interesting is that this value is always positive. Higher volatility increases the likelihood the option finish more deeply in the money or out of the money. Now, you might think, well, then don't those two effects offset each other? No, because since the downside of an option is limited, higher volatility increases the likelihood of a very large payoff as the option moves more deeply into the money. But um, which is, well, of course, that's a huge benefit to the owner of the option. It also increases the likelihood of uh, suffering the maximum loss as the option moves deeply out of the money. But the point of it is that because the upside is unlimited, the downside is limited, by adding the same likelihood of getting into either situation, you're benefiting more from that upside potential than you're losing from that downside potential because it's limited. So, in other words, if I'm doubling the likelihood of getting a huge gain or huge loss in the stock price, on the downside, there's a cap to how much I can lose. On the upside, there's no gain maximum. So therefore, on balance, I'm better off with a more volatile asset than a stable asset. So because of that, the Vega is positive. So like the gamma, Vega is the same for both calls and puts, the same asset, strike price, and maturity. It is also always positive. In fact, I'll show you the graph. You'll see that it looks something like, it looks similar. By the way, these are also, of course, they're all partial derivatives. And you'll see the formulas as you go through here. The graph for Vega looks a lot like gamma, except magnitude over here. The gammas are really small, like fractions. The Vegas are quite large, as you can see, but the shape is very similar. And that leaves really the only one, the last one, which is really probably the least important. Rho is the sensitivity of an option to changes in interest rates. call row is always positive and put row is always negative. So realistically, because interest rates don't change very dramatically over time, not certainly during the lifetime of an option. And so here's the call row. It reminds you a lot of the delta, doesn't it? And the put row, if you notice, like with the call delta and put delta, they're identical except for their signs. Okay. Or at least their behavior is the same. Okay, so that's really all we needed to say about Greeks. Um, if we had a longer semester, I could have given you an assignment where you wrote some code to calculate the Greeks. It wouldn't have been really all that difficult because they're all derivatives of the Black-Scholes model. But sadly, we don't have that much time, so we'll have to put that aside. What I really want to do is make sure that we don't miss out on the binomial option pricing model because that's where we learn how to price American options. So that one will have to wait till next time. That would be chapter 7. But the great thing about the option pricing model is not just the binomial option pricing model. It's not just teaching us how to price American options, but it's also giving us some insights into what's actually going on behind the scenes with the Black-Scholes model, because it is based on the Black-Scholes model. It's just a different way of implementing it. And in fact, as the name suggests, it is based on the binomial distribution from statistics. So we'll do that next time. And then in the meantime, I'll post all this good material and you can get started on that assignment where you're basically just pricing some call and put options using the template, which I hope will work successfully. And then we'll wrap up everything with our discussion about the binomial option pricing model. I'll also post the slides that I've written for Monte Carlo simulation if you're interested in reading them, but just be aware that they're primarily used for pricing exotic options. Okay. Anyway, so we'll have to stop right here and I'll see you all next time.